Minutes in. So really good to see everyone. So I have never really done this particular presentation before. If you've seen me speak before, you know I usually talk about, I talk to entrepreneurs about how to raise money in alignment with your goals and values. And but for this, I'm talking about, what does it take to create an entrepreneurial ecosystem that really, really works, that actually results in successful entrepreneurs growing and having the resources they need. And so I'm just going to kind of share some thoughts, and I definitely want to make sure we have tons of time for discussion and sharing ideas. But anyway, for those who don't know me, I'm an attorney. I've been an attorney for 25 years. When I first got out of law school, I spent the first 11 years at a nonprofit community development organization, helping to do, we built social enterprises, we did real estate projects, we did a lot of small business assistance. So I just became really, really passionate about community economic development and all that that means, helping businesses in communities be more successful so that they can create jobs and keep wealth local and all of that. So, and also keep uniqueness, so that we have special places and we don't go to any town USA and they all look the same. So, but then after 11 years there, I met a securities lawyer and I found out about securities law, which is the law that governs how businesses can raise money from investors. And that's not the correct thing to be sharing. Are you, did you mean to share that? That is not, those are not my slides.
Oh, I'm getting there. Sorry.
Okay. You might have to unshare and reshare. Sometimes if you click on one thing, you have to switch. But anyway, so I learned about securities law, and I found out that there are all these complicated laws that make it kind of tricky for regular businesses that can't afford super expensive lawyers to raise money. And so I just got really fascinated with that and started trying to understand, how can we make fundraising that is done correctly from a legal perspective accessible to more entrepreneurs and also accessible to more investors. So I've been doing that now for almost 15 years. So my main work is helping entrepreneurs raise money. But I do other things too. I also have an angel group, which is open to everybody, regardless of wealth or income. I also have a fund called Opportunity Main Street, which is an opportunity zone fund. So how are you doing on sharing the slides?
Just a sec. Sorry.
So the good news is I've seen a lot of success stories. But I have to admit, like, some of the things that I've seen work, if you had told me about them when I first started working on them and said, this thing is going to be successful, it's going to raise millions of dollars, I might have had my doubts. But I've had many, many occasions to see really amazing things happen where truly community-based businesses and initiatives got funded in ways that were more open and more democratic. And and so I've seen kind of what can work. Hey, can you go to the first slide?
Yes.
So I've seen what can work, and yet I've also seen how we are not even close to having a supportive ecosystem. Still not at the first slide. Okay, that's the first slide. So we're not even really close to having a complete ecosystem that will support the kinds of successes I've seen, that will make those successes common, where we will just see them all the time, and they'll kind of happen easily without a lot of headaches and, gnashing of teeth. So I've been thinking a lot, what would it take to really have a healthy entrepreneurial ecosystem? So next slide. So one thing that I just feel really strongly about when we're talking about building a healthy entrepreneurial ecosystem, it has to be outside of the venture capital model. And I don't think that's a really controversial statement, because everyone who knows anything about business finance pretty much knows that venture capital is only appropriate for probably 0.1% of businesses. I mean, anyone will admit that, including the venture capitalists themselves. So, and when I say venture capital model, I don't just mean venture capital. I also mean everything that is part of that ecosystem. It's a fairly well-developed ecosystem. There's angel groups that are feeders into venture capital. So that ecosystem is actually fairly well developed. It's huge. It's doing great in a lot of ways. But if we want to create a truly supportive entrepreneurial ecosystem, we have to find ways to build. We have to find ways that entrepreneurs can access funding that is not part of that model. So I'm curious, does anyone just have any comments or questions on that first point? Because some would say that I think it's non-controversial, but I just want to make sure no one is, if you disagree, I want to hear. Because a lot of people right now are building new VC style funds. It kind of makes me a little sad sometimes, because a lot of people who are trying to diversify investing and bring more equity and inclusion into investing, the way they do it is they'll build a VC style fund and bring in people of color to run it, or they'll try to invest in more people of color. But to me, that's not a bad thing, but it just doesn't solve the problem, because we're just not reaching 99.9% of businesses. So next slide. So, just to go a little bit more into detail on why that model is not a fit, why we have to do something that's not continuing to build up that model and create more options within that model. And we need to do something that's it has a completely different model, is that the venture capital model is one size fits all. You have to be a fast-growing company that's able to scale huge. And of course, most companies that do go into that system don't make it, because they just can't be successful on the terms as defined by the VCs. You have to have an exit. You have to be thinking about how are you going to sell, who are you going to sell your company to? And you're thinking about that from day one. And that's just doesn't make sense for a lot of businesses. They don't want to be pushing for an exit. They love their business. They don't want to have to focus on exit. They want to focus on running their business. Honestly, the financial return comes first in that world. Mission may be a nice to have, but it's not the primary consideration. So if we care about supporting businesses that want to make the world a better place, we have to have a different model. Unless you happen to be one of those very rare businesses, which I don't know if these even really exist, that is making the world a better place and has the ability to have a huge exit and make everyone rich that invested. That's very rare. Of course, the people who get venture capital is a very, very select few, mostly privileged white males. Again, it's not a fit for 99.9% of businesses. And the model just continues to concentrate wealth in fewer and fewer hands. So if we care about trying to reverse that concentration of wealth that we've been seeing get so bad in our country and the world, we have to look at different models. Next slide. So so what I want to do is build a WeC model instead of a VC model. And this is just a silly name, I'm not stuck to it, but it's just a term I use sometimes to describe what is this alternative to VC that we have to be creating? And so we could call it WeC. So it's all the people who are not venture capitalists and are not feeders into the venture capital ecosystem, they might be interested in investing. You know, how do we engage them? Next slide. So I did a calculation. I wrote a book 3 years ago, and for the book, I did a calculation to find out, of all the investors in our country, what percentage are professional investors? And when I say professional investors, I mean everyone from an active angel to a venture capital fund manager to a, you know, basically anyone who thinks for their day job or for a large percentage of their time thinks about investing. And only 0.3% of investors in our country are professional investors. So there's all these people out there who have money to invest, they are investing, but they don't have the opportunity to invest in the small businesses in their communities or, you know, businesses that they believe in and care about. They mostly are just able to invest in the public markets, in the, you know, Wall Street listed companies. Next slide. So, you know, we need to go back to the traditions of, you know, our ancestors, that for thousands and thousands of years, there were, it was a really big part of most cultures to have circles where people would pool their money to fund ventures. And this map shows the names of some of these in the different cultures all over the world. A lot of people have heard of susus. Those are in Southern Africa, I think. And but all of these are names for groups of people who get together and fund ventures that they care about. So this is the traditional way of putting together capital. Traditional business finance is we capital. VC is only a few decades old. So we need to get back to the tradition of community support for ventures that we care about. Next slide. Okay, so what would this ecosystem look like? So basically it has an infinite number of options. There are different kinds of funding for different needs. There's no pushing people into a one-size-fits-all model. The goal for the businesses that receive funding is healthy, sustainable growth, not pushing for an exit or, you know, domination of the entire market. Mission is valued as much as financial return. It's accessible for all to participate, and it can be a good fit for any business. Next slide. So I'll just share a couple of examples of things I've worked on. I have many, many more examples. Next slide. So Community Foods Market, they were one of the very first clients I worked with when I first started doing this work. It was basically a guy with a dream to build a beautiful supermarket in a low-income neighborhood, which wasn't just a place to get nutritious, delicious food, but also a place for the community to gather. The goal is for it to eventually be a worker-owned co-op. And so when he was just starting out, this was one where I was like, oh my God, this is going to be tough, because he had no location. He had certainly no revenue. He had never run a grocery store before. This neighborhood hadn't had a grocery store probably for a few decades, but he was really persistent, and I helped him design a way to raise money from the community. And this was back, I think this was, when was this? Maybe in 2010 or so. I can't even remember. And he ended up raising 1.7 million. Others, you know, once he raised that, he was able to get more people to come in and support, like more institutional funders came in and banks. And what he offered to his investors was a 3% annual dividend, but with no guarantee of any payment for the first 7 years. So it wasn't a really outstanding return, but he was still able to do it. So that, I'm so lucky I got to witness that, because it made me realize, you know, anything is possible if you have the right set of resources, skills, and supportive community. Next slide. So this is something I worked on a few years ago in partnership with Lift Economy. We started the Force for Good Fund, which is a investment fund. We raised money from about 130 investors. The minimum investment was $1,000. And we raised about 1.1 million. We invested it in about 13 companies. And we were able to do it on terms that are very, very supportive of those companies. So those are just a couple of examples of things that have happened. And again, I do have many other examples if you want me to share any more, but things that have happened that kind of demonstrate what can be possible. I will say that this particular Force for Good Fund had a limitation in that because it's a fund, it's a little more limited from a legal perspective in what it can do. So we had to raise debt and invest debt. And I personally feel I would have preferred to have done equity investments, but there wasn't really a great way to make that happen under the current law. And I can explain that if people have questions. Next slide. So this is just my kind of thoughts about what this would include if we could bring everyone to the table to make this ecosystem happen. And just think about, when you go on, if you have a Schwab account, like you go on to Schwab and you just like click a button and you invest. I want someday for us to be in a situation where it would be that easy to invest in the businesses that you love and care about that are not publicly traded. So I've been thinking about, how do we start getting there? How do we build that ecosystem? So, and these are just my thoughts. I can't wait to hear what everyone else thinks about what is an ideal ecosystem. So for me, it's important that it be open to everyone. So any entrepreneur that needs investment capital should be able to access it. And any investor, any person who wants to invest that way should be able to do that, to invest that way. What is the role of individual investors? So, right now, individual investors mostly aren't really organized. Like they're just sort of out there with maybe their retirement account or their Schwab account or whatever, and they're not really talking to each other and figuring out, how do we want to invest? What do we want to put, what do we want to support? So there are angel groups out there, of course, but what bums me out is that the angel community is mostly very much in the VC model. It's changing a little bit. If you go to angel conferences now, you will see people talking about alternatives, but still the angel groups are mostly focused on the VC model. So I wish angel groups would kind of start to be more open to other styles of investing, other types of investments, maybe just to diversify their portfolio. Like I said, I do have an angel group called Angels of Main Street, and I can share the link to that in a second. That is an angel group that's open to anyone. You don't have to be accredited. It's for people of any wealth or income. And in that group, we talk about investing directly in businesses that we care about that are not necessarily, probably not on the VC path. So we need to be organizing individual investors to take more control of their portfolios. And as I said, 99.7% of investors are not thinking that much about the fact that they are investors. Like if you were in a room with them, if we were all together right now and I said, raise your hand if you're an investor, most of those people would not raise their hand, even though they are investors. What about funds? So funds, I did a fund with the Force for Good Fund. I have mixed feelings about trying to create funds to solve this problem. I'm a little bit of a bigger fan of just the direct investing from an investor to a business, because when you bring in a fund, it just adds so much to the complexity and the expense. And return expectations can be, it can be a little tricky to satisfy your investors. You have to make it really clear exactly what you're going for. Like I said, when you do a fund, there's more legal constraints on how you can set it up if you want it to be open to everyone. I do have a fund though. Like I said, Opportunity Main Street is an opportunity zone fund. And the reason I started that fund is because when I found out about opportunity zones, which we could talk about more, is they are a tool that creates a huge tax benefit for investing in areas that are less, less lower income areas. And they don't have, there's no way to make sure that that money is actually benefiting the communities where it's being invested. So I started a fund to see if I could create a model of opportunity zone investing that would actually increase the wealth in that community instead of extracting it. So there's funds, there's philanthropy. So what role can philanthropy play? I think philanthropy could play a big role by helping out with things like guarantee funds and matching funds. One idea that I've had is when a business is raising money using investment crowdfunding, kind of like how I did with Force for Good Fund and how that company did, the supermarket did, you're raising money from the public and you're setting your minimum investment low and you're wanting everyone to invest. If you could have some kind of a guarantee fund where you said, hey, worst case scenario, if this business doesn't make it, you will be made whole. You will get back the amount that you invested. That would just really grease the wheels for people to be able to actually raise money from their community. So I think philanthropy would be hugely beneficial if it could provide that kind of a backstop for those kinds of investments. And so investment crowdfunding platforms, these became legal in 2016. It definitely makes it easier for entrepreneurs to raise money from the community. It's, from a legal perspective, it's a little bit easier in terms of all the regulatory things you have to deal with. Some new rules just came down the pike is going to make it even a little bit better. And what about secondary trading? Like once you buy stock, like let's say I own stock right now in Community Foods Market. What if I wanted to sell that stock to someone else? I probably could, but how would I find that person, and how would we facilitate it? And would we need to get like a legal opinion? So facilitating secondary trading is a big goal. I actually first got into this work because I was hoping to create a local stock exchange. And we never were able to do it because the rules are just so complicated for setting up an exchange. But there actually has been some loosening up of regulation ATS, alternative trading systems, which could make that possible. And then of course, we need to support the entrepreneurs. If we're gonna do this direct investing instead of a fund, the entrepreneur needs a lawyer to deal with the compliance. They need someone to help them draft their term sheet because your term sheet is very important. You don't want to be using an off-the-shelf term sheet. You want your term sheet customized to your situation. And then of course we need an active community that wants to support this business and be involved. And it doesn't have to be geographical. It could be based on interest. So I'm going to stop there. As usual, I went on longer than I expected to, but we still have plenty of time for discussions. I'm going to see maybe what people put in the chat. Let's see. Actually, you know what? Instead of me reading the chat, why don't we do this? People who would like to ask a question or make a comment or contribute anything, if you could just raise your hand. You do that by clicking on participants and then click raise hand. And you can stop sharing the screen. So if you put something in the chat, maybe you could raise your hand and say it. Because I don't want to sit here and read the chat while you guys are watching me. Right. Bobby.
I'll jump in there because this is one thing I wrote in the chat, and then a second thing that corresponds to what John was saying about this blurring of philanthropy and investment. And I'm here in Maine, and we have a brand new fund called the Indus Fund that I'm proud to be part of. We pitched in money and partnering with a credit union. That credit union is running the loan process specifically to immigrants who are starting businesses. But by having our dollars rather than their regular dollars, they can give below market rate. We're keeping it to 3% on the loans. So I'm proud to be part of that model, and so I'm spreading the word about it as a concept.
Okay, great. Anyone else?
I had put a note in the chat when you offered to explain more about the limitations of debt as part of the fund. I'd like to hear more about that.
So why the fund like had to do debt? Yeah, so I will talk about funds and how there's some legal limitations that make them frustrating. So if you're doing a fund, and a fund is defined under law basically as any business that takes money and invests it in other businesses and holds the securities of other businesses. So even if it's only 40% of your assets, you're still considered an investment fund or an investment company. So if you fall under the definition of an investment company, you're regulated by the 1940 Investment Company Act. And the regulations of that law are incredibly onerous. Like it's basically everything you need to do to be a mutual fund. So if you want to raise a fund, the default rule is you have to spend millions of dollars to set up your fund and millions of dollars each year on compliance. Now, there are some exemptions to that rule. And one exemption is the one that like VC funds and like hedge funds use. And that's one where you can actually you can do a private offering and have up to either 100 or 250 investors, depending on the size. So that's the standard thing that people use for a private fund. So that's fine, but what if you want to raise a fund from the public? Like you don't want it to just be private. You want anyone to be able to invest. You don't want to limit it to 100 people. Then you can't use that exemption. So there's another exemption you can use, which is the nonprofit exemption. And that is if you're a nonprofit, you are exempt from the regulations of the 40 Act. But the problem with it, so if you look around and look at kind of these democratized funds that are out there, like RSF Social Finance is one, Calvert is one, Pioneer Valley Grows, Force for Good Fund, Ujima, Boston Ujima, there's a few, there's probably about 15 or 20 out there. You'll notice that they're all nonprofits. And that is because of that reason. Because if you want to publicly offer an investment opportunity, you have to make it private. I mean, you have to deal with, you have to be a nonprofit or else you'll have to deal with tons of regulations. So when you're there's nothing wrong with that, but when you're a nonprofit, you cannot bring on equity investors. You can only bring on debt investors. So if you bring on debt investors, probably you're going to use that money to invest in debt and not equity. So that's the story with that. Brenda.
So one of the things that I keep hitting my head against the wall with it, just the incentive structure at the individual investor level. And it's the reason I think that a lot of angels have more of a VC-like model, because they're looking at how to invest their money, and they can invest that at a normal market rate with very little risk. And so to take on additional risk for lower than market rate returns is a disincentive. And we talk about blurring the line between philanthropy and investing, which is, I believe, the way the world needs to go. But for an individual investor, if I donate that money, I get a tax break. But if I invest that money, then I don't get that tax break. And if it does give me a return, now I'm taxed on the gains, even if it's a lower than market rate return. And so what exists so far, and what do you think could exist to help incentivize individual investors to put their money toward these purpose-driven, lower return, but higher value businesses.
Well, I just want to really question whether it's necessarily truly lower return. If you look at the performance of the VC industry as a whole, is there a way network 3473 could mute? I wasn't able to do it myself.
That's Barbara. Barbara, could you mute yourself?
Huh?
Could you hit your mute button?
Oh, sure.
So, you know, the average returns for VC style investing is actually 0 to negative. You said it was low risk, but I don't think that's actually true. I mean, if you talk to, you know, most angels, a lot of them just have money sitting out there that they may never see again. So I don't necessarily want to assume that this is always going to be below market rate. I think there's going to be a range. There's some investment, like an example is Equal Exchange. They pay a 5% annual return and it's very reliable. I mean, it's not guaranteed, but they have always paid it for many, many, many decades. And 5% might not sound high, but there have been many periods of time where that was way better than what the stock market was doing, what the S&P 500 was doing, or the Dow. So I just think we need to be a little more rigorous in asking, in talking about what is a market rate return. Because even though you're promised like, you know, 15 to 30% return on those VC style investments, is that what actually happens? No, I mean, it's unusual. It's very unusual that people get those kinds of returns. So, and then on the other side with philanthropy, you get a negative 100% return plus a tax break. But if you make an investment, you may well get a return. So like, for example, with this community foods market, if things work out, and we don't know for sure that they will, but he's doing pretty well, the store is now open, you get your money back plus a 3% annual return. That's way more than a negative 100% return plus a tax break for philanthropy. So I don't know, I just think we need to be a little more creative in our comparisons. But I'm curious what you think about that.
I think that's a really good frame, and like what I'm bringing to the table are like what all the objections that I hear from my investor friends, like why they're resistant to moving. Well, they'll personally want to move toward more social businesses, but there's still that I need to make enough money, and that pressure for the business to perform or prove it can perform at a certain level. And I think a lot of investors are used to the VC model, you know, where I didn't mean to say that VC is low risk. VC is high risk, but potentially very high reward, versus a stock market, which is somewhat lower risk, or you know, different bonds and other opportunities. What I hear there is there are kind of two frames. One is, this is philanthropy, but with a rate of return. Even though there's a risk, if you invest well, you can on average make money while doing the same amount or more of good, because social purpose businesses can often do more in the long term with the money than the nonprofits, and that some business models will actually be able to show from the get-go a high enough probability of a large enough gain to be appealing to investors who are focusing more on how do I make this a good financial investment for myself, instead of philanthropy that pays back. And so I think we're going to end up with these sort of two different markets. One for the philanthropists who, you know, are basically doing philanthropy as investing, and then the other ones who are looking at I'd like my money to do some good while still being my best financial investment. And there are those two different camps. And I think it'd be really cool to be able to engage more of that second camp, but they're the harder market of investors to reach.
Yeah, I just feel like if people would be a little more realistic about what the actual returns are. I mean, I do get data. I'm a member of Angel Capital Association. Probably many of you are. If you're a part of SVC, we automatically get to be members of that. And they do share data, but I'm skeptical. I don't know. I wish there was a way to find out truly what is the average return to angel investors. I just, from the anecdotal stories I hear, there's a lot of people with money out there that they don't know if they're ever going to see it again. And if you were to take, people tend to talk about the ones that do hit it, but they kind of forget about the ones that didn't. So I'm just really skeptical that people are making such high returns on average in that angel VC world. There are obviously examples of people who did, but if you look at the entire pool of capital and averaged out what returns are people actually making? I mean, there was a study done by Kaufman that showed, and this was a little while ago, but it showed it was on average 0 to negative in the VC world. So I just question whether people really are having to give up returns. Now, of course, every business is different. Like the community foods market, they're offering a really pretty low return. And it was a really high risk investment. That's the hardest combination. Low return, high risk. It's the hardest combination. But people loved, that one probably people did think of it as philanthropy because they just loved the idea. But then there's other ones where they're paying, 5, 6, 7, 8% annual dividends. That's actually a pretty good return if you believe that the business has a good shot. And, many people would say that a truly mission-driven, community-supported business is a lower risk investment.
So I would like, if there's time, to dig in a little bit more into this conversation about philanthropy and its role in this ecosystem. But if we could back up, you gave equal exchange as an example, and some of us are familiar with it and some of us aren't, but just a little bit more without telling the whole story, but some of the features of it that make it work. And of course, that return that you mentioned is not a guaranteed return. It's just a historical performance, right?
Yeah. So Equal Exchange has raised, I think, about 20 million over the years. They go out and raise on a fairly regular basis because it's a capital intensive business. And they always offer the same thing. It's a non-voting preferred stock. And it has a preferred dividend of 5%. Or a target dividend. They can pay less, they can pay more, but generally they've usually paid about 5% a year. And every time they open up the investment opportunity, they have people clamoring to get in. There's like a waiting list because it has been this reliable thing for many years. They've been doing it, it's been a few decades now. And what's really interesting about their model is there's no way that you can ever benefit from an exit. So they built into their model, their articles of incorporation, that if they were to ever sell the company, like to Nestle or Procter and Gamble or whoever, any proceeds from the sale beyond just the original amount that people invested would have to be donated to charity. So it's a stock that has absolutely no chance of ever increasing in value.
And it's also, just to sort of disclose, so I manage a foundation that invests in Equal Exchange, and it's a very safe place to park your money and get a little return and do social good, because it's basically supporting mostly cooperative farmers in the global South producing coffee, fruit, nuts, that kind of stuff. So anyway, and the original investors were philanthropy-minded investors, faith communities mostly.
Yeah, and of course the stock market has been on fire for a little while, but we forget maybe that's not always the case. I mean, they have a chart of a certain period of years where they show that if you would have invested in equal exchange versus the S&P 500, you would have done way better with equal exchange. That's probably no longer true. Thanks to all the engineering that's done to keep our stock market nice and inflated. But, you know, 5% is not a bad return if it's, you know, reliable. What else? Come on, share your success stories. Anyone?
Hey, Jenny.
Hey, Ken.
So I feel like with all these programs, sorry, all the programs this week, I want to know like where the SBA fits in, especially now that we have a hope that the SBA will actually start supporting, you know, diverse small businesses. So yeah, so can you address that?
The SBA.
Yeah, I mean, is it sort of, you know, is it, yeah, I guess that's all. I don't know what more to ask. Just how does the SBA fit into this, or maybe it doesn't at all?
I don't know. I mean, you know, they have a very traditional model of making loans through banks, which a lot of businesses don't qualify for. You know, we should talk about equity versus debt, you know, because it's an interesting conversation. I hear a lot of people say, oh, we need an alternative to VC. We need debt. And I'm like, not necessarily. Is debt really what we need? There's a lot of debt available out there. I don't want to say it's easy to get debt, but I know when I had a small business with my previous small business with no collateral at all, I was able to get a nice loan from a nonprofit lender. You know, it's not that hard, especially if you put your personal guarantees up, your house, if you put your house on the line. But is that what entrepreneurs mostly need? I think a lot of entrepreneurs need something more patient, more supportive, which is equity. And a lot of people don't realize that there's ways to do equity, like the equal exchange example is equity that is not the VC model. People think there's only one, that debt is the only alternative to the VC model, but no, there's many ways to do equity that is also not the VC model. So I just think that a lot of us who are trying to help small businesses focus too much on debt. And that's why I feel a little bad about the Force for Good Fund, because it had to be debt. I think what a lot of entrepreneurs need is more patient money that sits as an asset on their books and not a liability. And you know, yeah.
I was going to say, the SBA does have an equity arm, Small Business Investment Corporations. I've never quite understood them, but anyway, so I just feel like
that also. I thought they also did that.
Yeah, I just think that there's an opportunity, whether it's work helping the SBA understand better how to market the SBIC program to these businesses, or I don't know, creating more flexibility in their standard products. I think and hope that there's an opportunity for SBA to become a lot more active in supporting, you know, sustainable businesses.
Yeah, I guess I just I'm not super, like, I don't spend a lot of time thinking about the SBA because I just feel like they're a little bit kind of old school and not very creative. But who knows, maybe we'll get like an amazing new SBA director that just has their act together.
That's my hope. Yeah, I worked at the SBA when Erskine Bowles was in charge. So like we did so much good work back
then. So could I put another question on the table? I mean, I'm curious, in your ideal ecosystem that you put up in the slide, there's other ways of thinking about the philanthropy piece. And I'm wondering how you or others feel about funds that make it possible for the entrepreneurs to make philanthropy into their business models from the beginning. And I think there's a case to be made that businesses that choose to do that may be a big factor in their success. There are plenty of examples of that. But also, though, given the sort of growing interest in that model, a lot of the philanthropy piece is added as an afterthought. It's either insincere or they do a hack job of it and it comes back to bite them in the end. But it is possible for a business to be philanthropic before it's profitable. And that in turn makes it more profitable if you take the long view. That's my opinion anyway. So, but I wonder your thoughts, like where that kind of approach fits in and who's been doing that effectively, if anybody.
Yeah, I mean, a lot of the entrepreneurs I work with, I only work with highly mission-driven entrepreneurs, and they'll often build in a philanthropy piece to their business. They'll say, we take 10% of our proceeds and donate it to this, you know, and I discourage them actually from doing that because I feel like they have enough challenges getting started and they're already so mission driven. Like they kind of feel like they have to add on this extra thing to prove that they really are mission driven, but their whole business is mission driven. Like everything about them is making the world a better place. And their values are so strong in terms of how they're, you know, how they want to treat their workers and the environment. So I actually sometimes, I feel like you know, highly mission driven entrepreneurs can almost shoot themselves in the foot because they want to do so much good right out the gate that they'll kind of tie themselves in knots proving that they're these amazing, like, you know, they do everything, you know, and they want to set up as a co-op and they want to be a multi-stakeholder co-op and they want to, you know, be a limited, low profit, limited liability company. You know, it's like they want to pick off the shelf all the different bells and whistles to prove that they really care. So I tend to discourage it until they can get their feet on the ground, settled, and you know, have healthy revenues. But you know, I'd love to hear your examples of where you think it's worked well, because I do think sometimes it just looks like this add-on, like, oh, and by the way, we donate 5% of our proceeds to so and so, you know.
Well, I mean, like you, I think I can think of more examples where it hasn't worked, but conversely, so I'll give you an example of where I think it's worked well. So when SurveyMonkey was growing as a business, they have two revenue streams. They have the stuff we've all seen, and then they have a market research arm. And they decided to make that a charitable operation from the beginning, so that people who take market research surveys, instead of getting paid to do it, donations are made to a charity they pick out of a curated list. Anyway, that's been a huge driver of growth for that piece of their business. And it was many, many years for both SurveyMonkey and its nonprofit partners before it yielded any significant philanthropy. But it was a key driver of the growth of their business. So I'll give you that. That's a sort of a higher profile, bigger example that didn't require outside investors like us to make it happen, that piece of it. Obviously, the other aspects of the company, yes. But so anyway, that's one. And I just think that if you have entrepreneurs that want to do that, why wouldn't we figure out ways to help them do it wisely, even if they're creating a structure and a system so that when they're able to actually turn it into reality, it's already there from the beginning. So yeah, as the business grows, the philanthropy grows.
Yeah. I think
that's logical, not
it just, I guess when it feels like it's a really sensible part of the business, I love it. But when it feels like it's just this bolted on extra thing to prove we really do care, you know, then I say, let's put that to the side for now.
Like the Tom's Shoes model was fantastic because it was built in to who the business was.
Yep, shoe companies, sock companies.
Yeah, so I see someone mentioned revenue-based financing. I do have a lot of experience with revenue-based financing. That can be done both as equity and debt. and it's funny, it's like it used to be considered this very fringe thing, but now it's become really mainstream in a lot of ways, and it's become a little bit, I mean, it's not cheap money in terms of the more mainstream players in the world of revenue-based financing. You know, there's people that are looking for super high high revenue companies, you know, that are generating significant cash flow, and they want to take a big chunk of that from you every month. So that's, you know, that's not at all what I would advocate for any of my clients, because they're still, you know, I mean, some of my clients have been around for a while, but they're still working on getting sustainable and healthy, and, you know, so revenue-based finance can mean different things to different people.
Yeah. The deals I've seen recognize that obviously people want the business to grow. So the revenue doesn't start until after. It's accrued but doesn't start till later.
Right. Yeah, I mean, again, another thing that I do think is an important component of a healthy ecosystem is the customization piece. Everyone's always trying to create templates so that we can scale, which is good. Obviously, I want to scale a healthy entrepreneurial ecosystem, but if we create one size fits all templates, I just feel like ultimately it's really doing a big disservice to the businesses, because every business is so different. So I just keep coming back to, they need the support to create their own customized term sheets.
Could you talk some more about crowdfunding, if you have experience with crowdfunding, and what the various, it seems like there are, I'm starting to notice that there are some platforms out there other than the big platforms that everyone knows about.
Yes, I'm actually a co-owner of an investment crowdfunding platform called Crowdfund Main Street. I forgot to mention that. So Crowdfund Main Street, they currently have an amazing offering up there. Actually, this is another great success story. Barrett Kohler Publishers. They're an amazing publisher. They're doing really well, even though the publishing industry as a whole is, you know, having its challenges. They've been just awesome at kind of pivoting to become relevant, you know, to continue to be relevant. And they're very, they've offered investment opportunities to their reader community in the past. So they have many shareholders. They also have a philanthropy component. They even have an ESOP, you know, they do everything right. And they've been able to pay their investors cumulative dividends every year for a while now. So they're actually currently offering an investment opportunity on Crowdfund Main Street. I'm not an investment advisor, so take it with a grain of salt, but it's a damn good investment. It's cumulative dividends, which means like even if they can't pay it in a certain year, you still they owe it to you. And they insisted upon doing that. I tried to get them to maybe not do that, because I'm like, wow, are you sure you want to do that? And they're like, yeah, we really do, because our business is profitable, it's successful, and we really want to make sure and share that with our investors. So anyway, what the heck was the original question? Oh yeah, so the crowdfunding. So crowdfunding, it became legal in 2016, the national crowdfunding. We were doing crowdfunding before that, but we had to do state-by-state registration. So like Community Foods Market registered in California to do their crowdfunding. But now there's this national federal law that allows you to do it throughout the whole country. You don't have to do state-by-state filings, which is awesome. And the SEC just came out with some new rules that it makes it more attractive. So now you will, once they go into effect, which should be fairly soon in a couple months, you'll be able to raise up to 5 million. And there's no investor caps for accredited investors anymore, or won't be. Because right now we have a situation where we've had people raising money on Crowdfund Main Street, and someone wanted to invest like $130,000, but they couldn't because there's a per investor cap that applies no matter how much money you have. So luckily that is going away. And yeah, what can I tell you about it?
So specifically for your crowdfunding platform, what kinds of businesses are eligible, and how many do you have on there?
Yeah, so that platform it's highly curated. It's only open to highly mission-driven businesses they do go through a vetting process to make sure they really kind of have their act together. And full disclosure, almost all of I think everyone who's raised money on that platform except for one, I've been their lawyer. so we make sure they do everything right. They have all their disclosures correct. They have their customized terms, that really fit their business. And it's right now there's only one offering up there. One thing we're working on is creating geographically specific pages. So we're trying to get together groups of entrepreneurs. Right now we have 2 potential places that we're focusing on. So let me know if you know anyone in either Atlanta or Montana. Okay, let me know, because Atlanta is getting pretty close. We have a group of entrepreneurs who want to all launch around the same time. So we're going to have like an Atlanta branded page for them. So it's a highly mission-driven platform. The bigger platforms like WeFunder and Start Engine, I was really kind of disappointed when those came to dominate the space, because I feel like they're just trying to recreate the venture capital ecosystem, but just bringing it to more people, which is really that, I actually was the person who wrote the letter to the SEC back in 2010 that led to the passage of the 2012 Jobs Act as part of a nonprofit that I started. And when I wrote that letter, it wasn't because I wanted to democratize VC investing. It was because I wanted to democratize investing that would be more supportive of those 99.9% of businesses that don't fit the VC model. So luckily I found this woman, Michelle Timish, who really wanted to start the platform. And because when it first started out, everyone was just saying, yeah, everyone wants to be a mini VC. And I was like, oh no, I worked so hard to get this law passed. And now all these platforms are not at all in alignment with what I was hoping would happen. And then this woman, I think it's the only woman owned and run platform. Michelle Timish came along and said, I want to do a platform. So she's great. What else? You're making me want to read all your text, but I know that would be really awkward because you'll just like see the top of my head for 5 minutes while I'm reading. So say something, don't put it in the chat.
I feel like so much of what skewed the investment world, like you were saying with the crowdfunding platforms, all these new investors were coming in like, oh, I get to be a mini VC. It's like there's this identity of, it's like this get rich quick scheme, or it's like playing the lottery, but with business investing, where people who don't really understand the ropes and how it goes, they're just hoping that if they throw money into a bunch of different companies, that one of them is going to be the next Facebook, and then they'll retire with all the money they need for life
after investing $100.
Yeah, totally. Oh, $100, not 100. Oh, one of them just made me $25 million. I'm set.
Shark Tank in there too, in terms of having an influence.
Yeah, totally. Yeah, if I get to be as much of an asshole as all the Shark Tank guys, then I'm definitely gonna make my 25 million. And I feel like it's a story that does not serve people who want to invest, and it's a story that does not serve businesses that don't want to participate in the VC model. And the question I'd like to throw out, I don't expect we'll answer it today, but what is a story and an identity that people can become as a more slow money investor that is equally or more appealing to this get rich quick VC identity, so that we can start to sow a story of who these investors can be and enlist them in a new form of investing, so that we can start to swing the pendulum back the other way.
Mm-hmm. Make it sexy to be that type of an investor. I mean,
is sexy.
It is, it is happening. I mean, it is happening. Like, I'm amazed how it's just been a few years. I used to feel like the lone voice saying we need an alternative to VC. And I feel like now it's a lot of people are saying it. I mean, even just this morning with Natalie, she's been saying it for a while. And there's the zebra movement. So there's so much out there. Believe me, I'm always looking for those articles about like VC completely debunked, you know. VC horrible for the world, you know. Because I'm always looking for proof. I mean, I'm not trying to like totally destroy VC, but I just feel like it has, as Natalie said, it's like taken over so much of the oxygen that we have to kind of throw rocks at it, and say the emperor has no clothes. You know, we have to be critical of it so that people can at least open their mind to there's other ways, you know. And not only that, it doesn't have to be one or the other. There's diversification. So even those people that are really into VC and like, yeah, I'm part of my Keiretsu forum and I've made all these awesome investments and I think there's going to be an exit in Q3, you know, why not take one little chunk of your money and invest it in more of like that long-term sustainable revenue-based type of investment? Like, it's just, diversification is smart. You know, you don't have to give up your allegiance to that VC model to try something different.
That's true.
Jenny, I was just going to say, I think Janine Firpo's book will help people to carve out their identity as investors too. Does that sound right?
Yeah. That's
So
what it's all about. Mm-hmm.
Yeah, Janine Firpo, you can follow her. I know she's on Twitter, and she has a book coming out about sort of this precise topic.
Yeah, I mean, it covers like all aspects of investing, and there's really just one chapter on like the private investing thing, but it talks about all the different models.
And Jenny, we don't have time now, but if you ever want to have the conversation, so I accidentally got involved in the VC world because I was working with purpose-driven individuals who happened to be associated with VC firms, which is one of the top 10 in the Bay Area, a very successful firm. And so I got to see from the inside exactly how they operate, how their business models make them financially successful, and also all the things that they sacrifice along the way. And it really turned me against the VC arena.
Add that to my book of evidence.
Yeah, so I'd be happy to share stories with you sometime. It's very interesting and very painful in a juicy kind of way.
Oh, I love it. Spill the tea, girl.
So I'm wondering, Jenny, you've mostly, I think, been talking about models that are place-based. Is that correct? Or
not necessarily.
Not hearing that necessarily. Okay.
I love place-based, but it doesn't have to be, you know, especially with crowdfunding now, we can do, you know, nationwide, even non-US.
I'm wondering if you or others on this call, I mean, there's, instead of doing place-based, looking at a sector that's exploding rapidly, that has huge sustainability and justice implications, and VC is already playing, but not exclusively, and there's an opportunity for investors, especially in partnership with NGOs and community thought leaders, to carve out a different path as well, and that's the legal cannabis industry, which has huge challenges, huge VC plays, big money, proceeding on sort of parallel tracks, one big sort of extractive economic development model track that just sort of comes in, gobbles up all the business and takes all the profits and takes them back to the VC investors. And then there's another model, which is sort of the craft beer analog, if you will. So I'm wondering if there's thoughts on that, and maybe that's not a good sector just because of, you know, some people find it uncomfortable or controversial, but there's a clear opportunity for intervention by, you know, purpose-driven investors and philanthropists and NGOs, and everyone seems to be sitting on their hands. So it might be a good one to think about, if not on this discussion then later.
Yeah, I actually was interviewed for an article in a like a cannabis publication, and it was all about FVC. And it was about especially talking about how women and people of color, I mean, the cannabis industry is kind of notorious for, when it was illegal, you know, it was pretty diverse in terms of who was involved. But once it became legal, the people that really started getting elevated and getting all the permits and getting all the funding tended to be white men, you know. So this article was talking about, you know, if you're a woman or a person of color in the cannabis space, like consider a different source of funding.
I don't know anything of the cannabis space, but it's kind of ringing a bell with me for the aquaculture industry, what's going on, because there are big international players, and in Maine there's Norwegian, these kingfish, there's these hundreds of millions of dollars are getting invested in large fish farms. And then we do have on the startup side some really interesting things going on, and some of those are in partnership with New England Aquarium is really getting into the whole aquaculture startup space, Gulf of Maine Research Institute. So there are several NGOs that are entering aquaculture, but it's parallel and different than the big fish farms. And
yeah, one thing I'm hearing is that a lot of investments that happen globally, you know, that are more, because a lot of aquaculture is outside of the US.
80%, yeah, of the fish in the US that we eat are imported, yeah.
Because there isn't much of a VC ecosystem outside of the US, except in a few countries. Like I'm hearing that in those countries, it's actually way more common to do things in more creative ways. So like in some ways, they're lucky because they haven't been force fed this one model that takes up all the space. And they've had to be more thoughtful about how do we fund this in a way that makes sense.
Well, with the Norwegians, it's government money. It's their oil money that's buying the fish, these big fish farms.
All right, well, we're gonna get thrown back into the main group. So thank you so much, everyone, for coming. It's the very last session of the conference, so I appreciate people hung in there, and feel free to get in touch. My website is jennykassan.com. You can always contact me through there. I'd love to hear more of your thoughts and ideas and examples.
Thanks so much, Jenny.
Thanks, Jenny.
Okay,
Thank
bye.
you, Jenny.
Bye.
Bye.
Oh, don't leave, because then you won't get put back in the other room. Just wait. I guess we have a few more minutes. Any last words? Let's see.
You can actually choose leave.
Oh, we can leave room. Okay. Bye.
Say a couple of words about Atlanta, because I do maintain a residence there, even though I don't live there anymore.
Yeah. Do you know businesses in Atlanta that might want to do crowdfunding?
Of course.
Okay. So what is your name? I know I should know you, but
Barbara Pyle. I'm Barbara Pyle. I was one of the originals at CNN, and I'm kind of known for creating this cartoon called Captain Planet and the Planeteers, which is shares a lot of it's a very SVN friendly model.
Okay.
Yes.
Well, I'm going to go ahead and put my email address in the chat. So send me an email.
I got it. It's JENNYKASSIM.
No, it's JENNY@JENNYKASSAN.com.
Okay.
Just put it in the chat.
That's above my pay grade. I'm lucky to be able to do all these Zoom calls all by myself. No, I was lured to Atlanta in 1980 with the promise that I'd love it. And it took me 25 years to get out, if not 35. I didn't love it. I was living in New York and just fine. And, but my mandate which was to create all the environmental programming and ethos and policy and all that, was quite avant-garde. And I ran with it in 1980.
And was that with CNN?
Yes, that was working for Ted Turner, right? Absolutely.
Cool.
So I know all those people.
I bet you have great stories.
Horrific. I'll have a couple of beers with Ian tonight and start unloading them.
Oh, do you live in Ian's area?
No, actually, I have left. I'm an expat. I live in St. Lucia, and I'm actually working on a lot of sustainable agriculture projects, Empowerment Women project. I think that's turn us off, but it was great to meet you. Are you going to come to Ian's party tonight?
Weekend. But I just wanted, before we end today, it's kind of an unceremonious conclusion to the conference. We don't have a big closing circle planned, but I just wanted to express just my deep thanks on behalf of the American Sustainable Business Council and Social Venture Circle for joining us this week. It's just been absolutely wonderful. We're gonna share some follow-up. All the sessions you wanted to attend, but you couldn't because they were concurrent. We're gonna try to get those videos cut and available to you as soon as possible on demand. So just thank you. There's so many things.
Thanks, Isaac. Thank you, Sante.
And the entire ASBC team. So with that, I am just going to do an unceremonious end. But again, really appreciate your active participation and making this week so fantastic. So
thank you so much.
We don't want to leave, Isaac.
I hope
we don't want to leave.
We
want to keep on talking.
Yeah, I do a closing circle next time.
Mic and applause for them.
Yes.
Yeah.
Thank you, everybody.
Thank you all.
Hey, Duncan. How are you? I'm like missing all these. And Jenny. Oh my God, look at all these people that
Thank you, my friends.
Hi, Arno.
The friends that I didn't get to connect with or hang out with. Thank you so much.
Everybody.
Thank you. Diane.
It was great to be with all of you.
Thank you. Thank you.
Stay healthy. Great. I'm just going to stay on until I'm like the last person to say it.
That's the way to do it.
Ian, I was so sorry
Hi,
for the session. Love you so much.
Hi, Terry.
Hello, everybody.
Hey, Laura.
Hi,
Terry. This is great.
Hey, Laura.
All right. Well, with that, I'm going to do a little countdown. Okay. And I'm going to be that guy that presses the button.
Bye, everybody.
And that's very high tech.
4, 3,